Credit markets turn before equity markets, and if you're waiting for the stock chart to tell you trouble's coming, you're already late. This is the MadBrooks professor, AI generated, not financial advice. Charlie, you've covered enough market cycles to know that when credit spreads start widening, equity analysts suddenly get religion about balance sheets. Walk us through what you're actually watching when you talk about credit conditions deteriorating.
The first thing I'm watching is the high-yield spread to treasuries. Right now we're sitting around 300 basis points, which is historically tight. When that spread pushes through 500, you're in caution territory. Above 700, you're in crisis mode. But here's what matters for equity investors. That move from 300 to 500 doesn't happen overnight. You get this progressive widening where the market is telling you that the compensation required for credit risk is going up. That means lenders are getting nervous. And when lenders get nervous before equity investors do, you need to pay attention because debt holders have a senior claim. They're closer to the cash flows. They see the deterioration first.
Give me the mechanical reason why that matters for stock pickers. I'm running a long-short book. I've got a portfolio of what I think are quality cyclicals. What does the credit market actually tell me that the income statement doesn't yet show?
It tells you about forward refinancing risk and covenant pressure. Let's take a concrete example. In 2007, I was watching homebuilders. The equity analysts were still talking about normalized earnings power, arguing the stocks were cheap on trough multiples. But if you looked at the credit side, the homebuilders had massive debt maturities coming in 2009 and 2010. Their revolver availability was getting cut. The credit spreads on their bonds went from 200 basis points to 600 before the equity really cratered. What the credit market was saying is, we don't believe these companies can refinance at reasonable rates when their debt comes due. That creates a maturity wall. The equity can go to zero even if the business eventually recovers, because you get wiped out in a distressed exchange or bankruptcy. The credit guys knew the capital structure was impaired before it showed up in earnings.
So you're watching the maturity schedule and the spread simultaneously. What's the threshold that makes you actually change positioning? Because spreads wiggle around, maturities are published facts. How do you know when it's signal versus noise?
The trigger is when you see both spread widening and the senior loan officer opinion survey showing tightening lending standards. The SLOOS comes out quarterly from the Fed. It's a survey of loan officers asking if they're tightening or loosening standards for commercial and industrial loans. When you get 2 consecutive quarters of net tightening, and credit spreads are widening at the same time, that's your confirmation. You're not getting a head fake. What's happening is the lending officers in the economy are pulling back credit availability. That hits capital expenditure first, then working capital lines, then refinancing ability. For equity investors, this means earnings estimates are too high because they're predicated on credit availability that's disappearing. I saw this in early 2019. The SLOOS showed tightening. High yield spreads widened out, and even though earnings were still okay, forward guidance started getting pulled. If you waited for the earnings miss, you missed the chance to de-risk.
Let's go sector specific. You and I both know that not all credit deterioration hits all stocks equally. Where does this show up first, and where do you get the false positives?
It shows up first in sectors with high financial leverage and low asset tangibility. Commercial real estate, leveraged retail, anything with a private equity sponsor that loaded up on debt. These businesses have low interest coverage ratios, and when credit tightens, they can't roll their debt. The false positives are in utilities and regulated infrastructure. You'll see their credit spreads widen in a general risk-off move, but they've got rate bases, contracted cash flows, and regulatory support. The credit market is being indiscriminate, but those businesses can actually access capital even in tough environments. So I'm using the credit signal to get short the high leverage, low visibility revenue businesses, and I'm ignoring the spread widening in defensive sectors with tangible assets and contracted revenues.
Talk to me about the maturity wall concept with actual numbers. What does a dangerous maturity profile look like for a company that might be in my portfolio?
Let's use a real framework. Say you've got a company with $3 billion in revenue, $400 million in EBITDA, and $2 billion in debt. That's 5 times leverage, which is manageable in a good environment. Now look at the maturity schedule. If they've got $200 million due in year 1, $300 million in year 2, and $1.5 billion in year 3, you've got a wall in year 3. The question becomes, what's the credit market going to look like in year 3 when they need to refinance that $1.5 billion? If we're in 2024 and that maturity is 2026, and I'm seeing credit spreads widen now, I'm pricing in that they're going to have to refinance at 400 or 500 basis points higher than their current cost of debt. That's 60 to 75 million in additional annual interest expense on that refinancing. You just took 15 to 20% of their EBITDA and gave it to lenders instead of equity holders. The equity multiple has to compress because the free cash flow to equity is going down structurally.
Last thing, you've been in the booth for enough market turns. When credit spreads tighten after a scare, when do you trust that it's actually an all-clear signal versus just a temporary squeeze?
You need 3 confirmations. 1, the SLOOS has to show easing lending standards, not just stable but actually easing. 2, you need maturity walls to get addressed. You need to see companies actually successfully refinancing their debt stacks at reasonable rates. And 3, you need high-yield issuance volume to come back. Not just a couple of deals, but sustained new issue activity where companies can access the market. If you get all 3, the credit channel is open again and equity markets can run. If you only get spread tightening but issuance stays dead and the SLOOS is still showing tight standards, that's a technical squeeze. It's short covering in credit, not a fundamental improvement. That's when you fade the rally in equities because the underlying credit transmission mechanism is still broken.
See you Monday. When credit spreads widen and lending standards tighten simultaneously, the cost of being wrong on your equity longs just went up whether earnings show it yet or not.